The big issue around this is that now, why is it a debt spiral? The issue here is that things like Social Security, Medicare, Medicaid, that's about $4.1 trillion. Our defense budget is $950 billion. Okay, so right there, that's over $5 trillion. We're already over budget. And can the US dollar hyperinflate? Of course it can. And it will if we continue on this path. There's just no other way about it. That's great. You have a problem. So what's the solution? Well, you've got three basic solutions. So when they go and tax those dollars, they pay down debt from before, past debt that with dollars that are worth less. So it's a trick. And they've been doing it all along, and they're going to continue doing it. And so what is the solution? The solution is
Bing bong. I am back with another edition of the State of Bitcoin podcast, where I've got the man, the myth, the legend, James Lavish in the house. He's living the lavish life as a former hedge fund manager, but now works with Bitcoin Opportunity Fund. He's also an ex-hockey guy. So we'll get into all of that. But James, I've read your newsletter about the debt spiral, and we're sitting at $35 trillion worth of debt. Every time I look at that debt clock, I get a little bit of a headache, maybe some motion sickness. But we've also got another $218 trillion worth of unfunded liabilities. So tell me, man, how are we going to get out of this mess? Or is it just, at this point, we're just going to make the money printer go burr?
Yeah. So, well, it's good to be here, Brandon. Always good to talk to you. And I appreciate you having me on your show. To quote a good friend of mine, Lynn Alden, nothing stops this train. There's nothing's going to stop it. So I talk about the debt spiral quite a bit, and it's not because I'm looking for solutions. There is really no solution to it. The only solution would be to stop spending, because we spend so much money, and that's really the big problem here. So people, they get confused, and you have politicians, you have political rhetoric. Oh, we're going to tax the rich. We're going to, you've seen some of the stupid policies that are being put forward by the Democrats right now. And I'm apolitical. I think basically both parties suck, and it's just a disaster. And so, but the reality is that you have a lot of people who are just not very well off, and they're frustrated, and for good reason. And so why are they frustrated? Because of inflation. Why is there inflation? Because of this problem. This is exactly what we're talking about. And so we talk about the debt spiral, and that really is the basis of all the problems that are out there, is the manipulation of money. And it's around this issue right here. So
yeah, let's break it down then. So then what is the debt spiral for those who maybe have not read it from your newsletter, and kind of break it down? Because I agree with you. At this point, there's no going back, right? The government, every year they bring in more and more money than the last year, but for some reason the debt just keeps climbing and rapidly climbing. It's basically this exponential curve that we're on. So what is the debt spiral? And I guess how did it even get started, and all from that?
Yeah, well, if you want to go back to the origination of it in modern times, it really goes back to Nixon taking us off the gold standard fully, which meant that there was no underpinning of asset value that our U.S. Treasuries would be attached to. So basically, they were not backed by anything. It used to be that you could take your dollars and go into the bank and say, I want my the equivalent of gold in back. But they stopped that, and they officially took us off the gold standard, and Nixon did back in 1971. And so what we've seen is basically the reason they did that is because they wanted to attach. They wanted to have the ability to manipulate the currency with the central bank, with the Fed, and then migrate the dollar to what we call the petrodollar, which was have an agreement in Saudi Arabia and around the world that all oil and gas or oil trade would be settled in U.S. dollars. And so that made the U.S. dollar the global reserve currency, which in turn made the U.S. Treasury the global reserve asset of the world, because other countries who were buying and selling oil, or buying their oil, they had to have dollars. So the way they would get dollars is by buying treasuries, and then sell those treasuries for dollars when they went to purchase oil. And that's basically what's been going on since 1971. But at the same time, The issue is that there was no check on how many dollars there were in the world. So the Fed, and through money manipulation and the way that our banks work, we create dollars out of thin air, and we expand the money supply. And the money supply has been expanding somewhere about 7.1% since 1971. And that in and of itself is the essence of the underpinnings of inflation, because more dollars chasing for goods and services that are not expanding at the same or faster rate than that money supply growth. And so basically, if you have the same number of apples with more dollars, and the same, the demand for those apples is going to grow in dollar terms because there's more dollars chasing them. So it's simple. But the debt spiral, that problem really has to do with our government spending. People get all over the Treasury about how much debt there is and how the Treasury is putting us in a terrible position. But the reality is, it's really Congress. It's the legislatures who are deciding how much we spend each year. And right now, if you look at everything right now, our GDP is just under $29 trillion, which means that's the gross domestic product. That's what we, as all of the citizens of the United States and the companies, are generating in dollar terms and productivity. And then tax revenues come off of that. And our tax revenues right now, according to the CBO, which is the Congressional Budget Office, and they every year put out the budget and show exactly what they're projecting, what they expect to make each year, and total revenues and total spending, and what their budget is around that. And they put this out every year. And so the latest one was updated, and in 2024, we expect total tax revenues this year to be $4.9 trillion. The problem is, Brandon, that our spending is $6.9 trillion. So that right there, it's just we're taking in 4.9 trillion and we're spending 6.9. So we have a $2 trillion deficit, which means that every single year that it stays at that level, we're adding $2 trillion to our debt. And you can go back and look at it, and our debt has been growing by multiple trillions of dollars over the last number of years. But the reality is that the big issue around this is that now, why is it a debt spiral? Well, we could just cut $2 trillion of spending, right? I mean, that would make us in balance, and we could get back to the years of so-called imbalance with Clinton, and we would be, we would not be adding to debt. But the issue here is that if you looked at the U.S. government and you considered it to be a company on the New York Stock Exchange, they would call it a zombie company. And what do I mean by that? I mean that a zombie company is operating even though it cannot pay, it doesn't make enough money to pay off its interest on past debt. So it has to borrow more just to pay that interest. Well, why is that? Okay, well, we just said the expected revenues, tax revenues, are $4.9 trillion. The spending is $6.9 trillion. If you break it down, our spending is mandatory spending. These are all the programs that are signed into legislation that they have to be paid for. This is legally, they must be paid for. Things like Social Security, Medicare, Medicaid, and other programs. But that's about $4.1 trillion. Our defense budget is $950 billion. Okay, so right there, that's over $5 trillion. We're already over budget. So right there, we're over budget. But we also so the defense, it's not signed into legislation and mandatory, but it might as well be, because these are long-term contracts with huge defense companies, and we're not going to stop spending on defense. That's just not the American way, right? So, but the third really big line item that comes in is the interest on our debt. And we spend over $1.1 trillion of interest on our debt each year. We get some of it back. The Treasury gets some of it back because it's intra-government debt. So, but the net is about $900 billion. So our total mandatory line items are $6 trillion. So, And then you've got another $900 billion on top of it. So where are we going to cut? Like, where are we going to cut enough to fix that? We're not. So what we're going to do is we're just going to issue more debt, borrow more money, use that debt that we just issued to pay off past debt that's maturing, and borrow to pay off more programs that we, just to enable all that spending. And that's what's happening every single year. And that's why our deficit is not shrinking and our debt is just growing and growing and growing. It's going to continue like this until something changes. And that is something that is that would be something catastrophic. And so we can talk through that. But right now, that's where the situation is. And there's no stopping it. So, people ask, Brandon, like, okay, so what's the solution? That's great. You have a problem. So what's the solution? What do you propose? Well, you've got three basic solutions. You could have austerity, which we saw back in the great financial crisis. Greece was forced into austerity by the EU, the ECB, and the EU by saying you have to cut programs, you have to cut spending, you're gonna start being responsible. Okay, so we could cut programs. You just heard what the programs are, and so where would that money come out of? Well, it would obviously have to come out of the entitlement program. There's nowhere else to cut. So you can't cut you're not going to cut your defense spending in half, and you're not going to cut your interest on your debt because you're not going to default, right? So the only spot is Social Security, Medicare, Medicaid. That's insanely that would be a political suicide. So, remember that politicians are the ones who are making these decisions, who are signing this legislation, who are coming up with a budget, and they want to get reelected. So that no politician would ever vote for that. So that's just kind of off the table. It's not going to happen. They'll just borrow more money and put it on the tab, which is the $218 trillion of unfunded liabilities you talked about. So that's one thing. So the second thing they do is raise taxes. So if you've ever seen, and there's a lot of debate about this, but you've ever seen the Laffer curve where you can at some point you maximize the amount of revenue you're going to get from taxes. Well, so you look over time and you look back, taxes are not, what happens is you raise taxes and you wind up lowering productivity. So companies who have, they use the money that they're earning to reinvest in profitable business lines, to reinvest in research and development, to create new business lines, hiring people, expanding, growing their footprint, and it grows that productivity. It grows your GDP. But if you raise taxes and it cuts their productivity, it closes their margins. What do they have to do? They're gonna get rid of or close down product lines are not profitable enough or are now losing money on. They're going to start letting people go and firing people, and your productivity goes down. So what you wind up having is higher taxes on lower productivity. You either get to the same spot or worse because now you've got declining productivity. So that's not a really good answer. Okay, so austerity, no. Higher taxes, no. So what's the third thing you can do? Well, the third thing you can do is just borrow more. Just take out another credit card and borrow more, which is what we're doing every single day. But that necessitates one more thing, and that's working with the Fed, which they're not explicitly working together on this, but implicitly they are, because what the Fed is charged with is maintaining a constant growth of money supply and inflation. And so they have two mandates, which are stable prices and full employment. And so those stable prices, the definition of that is constant 2% inflation. Well, why do they have that? Because basically what we said before is, Brandon, the US, they issue debt in their own currency. And any country who does that is not going to default on their own debt. Instead, they'll just print money and buy that debt themselves to keep the charade going, expand the money supply, right? So what they're doing is they're not going to hard default like that. They're going to soft default every single day. And soft default is inflation. That just means that they're debasing that currency and the money supply is growing so that when you borrow money, right? So say you're lending money to the US government, you're lending that money to them. They're going to give you that money back later, in years later, with dollars that are worth far less than you lent them when you bought that bond in the first place. So what they're doing is they're basically inflating GDP nominally, that productivity number we said, just in dollar terms, with dollars that are worth less. So when they go and tax those dollars, they pay down debt from before, past debt, that with dollars that are worth less. So it's a trick, and they've been doing it all along, and they're going to continue doing it. And so what is the solution? The solution is high perpetual inflation. It's constant, it's relentless, and it will not stop. The only question is, how high does that inflation get? And that remains to be seen.
Yeah, and that's a great breakdown. I really appreciate all that. But with that too, I mean, they've talked about the debt ceiling, right? They basically removed that essentially, right? And that doesn't exist. Do you think it ever exists? Was that a possible solution if they would actually follow it? Or, is that just I guess living in fairy tale land where they would control spending at a certain point?
Yeah, the debt ceiling is kind of a fallacy. What it really is it's a political defense mechanism or weapon, depending on which way you look at it. And what it does is it forces Congress to work with each other, both sides to work with each other on each side of the aisle in order to get things done, but keeps them in check, because the ultimate, answer is, well, we're not going to approve your budget, and because you would go through the debt ceiling. We would have to revise the ceiling higher in order to approve these expenses. But if you look back, that ceiling's been raised through both parties, in perpetuity. It's been raised dozens and dozens of times in the last 20 years. And so in the last 30 years, it's dozens of times. I think it was 19 times in the last 20 or 17 years, something like that. I have to go back and look at. It's ridiculous. It's a fallacy. So now we don't have a debt ceiling. What does that mean? Well, a year ago, we got into a problem where we ran into a debt ceiling. And so, what that means is we didn't have the ability to issue more debt. The Treasury was up against the wall. So they were like, we're going to start defaulting on stuff. We're going to have to stop paying government employees. We're going to have to stop paying all these programs, Social Security, Medicare. We're going to have to stop paying this stuff. And so you all need to figure something out so we can issue more debt, because we have to borrow more to pay this last set of bonds, and, and more to pay that deficit that we have, which we're not making enough money to spend. So they basically just said, okay, we're just going to suspend the debt ceiling until January of 2025. So now we're sitting here. We have an election coming up. Nobody's talking about it, but that's going to be on the table in January as to what is that ceiling going to be? What does it look like? And what's the budget going to be? Now, why do they even have it? If it gets raised every few years, why do they even have it? Well, it's the same thing like having a budget. It's just like a big charade. We can't have a currency that has no limits to the amount that we can borrow on. So we're kind of outwardly telling the world, oh, look, we're responsible. We have a budget. We have a debt ceiling. We're working to make sure that we maintain the value of the dollar. It's all a big charade. It's like they're play acting. And unfortunately for the rest of the world, fortunately for us, but unfortunately for the rest of the world, the US dollar is still the global reserve currency, and it's going to remain that until further notice. And because of that, the whole world just has to go along with it. They don't really have much of a choice.
Now, with all this money printing, right, there's always a worry that we run into, you said, where's the limit with inflation? As the global reserve currency, would it be a possibility that we even reach like a hyperinflationary world with the US, like kind of just continually printing away? Because obviously with these swings, right, we saw how much was printed in 2020. you'd have to think that we're going to print more than the next time around, and that's probably coming soon, right? Are you looking for the best way to store your seed phrase? Well, I've got it for you. It's StampSeed. They've got the #1 punch place where you can order a full-on package where they've got every single thing. They've got all the letters. You could just get it in there. And they've got this sick hammer, which they've engineered to make it so easy for you to punch in that titanium steel plate and store your seed phrase in the most secure way possible. So go ahead and get your Bitcoin off of these exchanges and use promo code Green Candle for 15% off. They're helping power the show. They've got the Bitcoin logo. You can punch it into your seed phrase as well. If you could see it here, they've got a lot of cool stuff. And now I'm helping empower you to get your Bitcoin off an exchange utilizing StampSeed and storing your seed phrase in the most secure way possible. Now get to it. All right, back to the show.
Yeah, it really depends on what. So we have a lot of indicators right now that are conflicting, but I think many of them are pointing towards us of heading into a recession. The jobs numbers we had a high unemployment number. That means that unemployment rate it's starting to accelerate. And if you look back in history, unemployment does not start going up and then suddenly come back down. It just doesn't happen. So once it starts accelerating, that's it. It starts really accelerating through into a recession. So that's something that keeping an eye on. Spending numbers, credit numbers, personal credit card defaults, they're all rising. And then this week, tomorrow, we're going to get the Bureau of Labor Services, the BLS, is going to revise their employment numbers that they've been giving us. And it sounds like they're going to revise them anywhere from 300,000 to 1 million jobs lower for this last year. That's significant. That means that they've overestimated the job market. The job market is slowing faster than they expected. So why does that all matter? Well, I mean, so to your point, where is inflation going to go? And how bad is it going to be? Well, it really depends, and how much are they going to print? Well, it really depends on what kind of flavor of slowdown we have. Is it going to be this, a grinding lower, a long, prolonged recession, which I don't believe that we could sustain. And if so, they're just going to print until we come out of that. And it could be, QE, in large doses over the course of the next 6, 12, 18 months. Are we going to have some sort of market shock? We saw the yen carry trade a couple of weeks ago. That was pretty scary. It was just a little taste, though. It wasn't really the big thing. But could we have some sort of market shock, whether it be anything from moving from a proxy war to an actual physical war, to terrorist attacks, to civil unrest, to contested elections, not having an election, all these things. Who knows what happens to the market in a shock? We just don't know. I would think that all those things people are thinking about, so they're somewhat priced in to people's thinking. But if you have something like that, we don't know what happens. It looks more like March and April of 2020, and the market just collapses. And if that happens, if the market collapses, then you will have an equal and stronger reaction from the Fed and the Treasury to inject liquidity into the markets. Because as the stock market collapses and everything sells off, and then bonds collapse, and then you have a problem with the bond market, that's where once you start bleeding into a problem with the Treasury market, that's where the Fed and the Treasury get nervous and they step in with liquidity. You saw it back you saw it in 2008, you saw it in 2019, you saw it in 2020. So we would have some sort of reaction that would be, I think, very powerful. And to your point, it would be magnitudes of the last print that we had. It wouldn't be $5 trillion. It would be like 8, 12, 15 trillion, something crazy, because the numbers have just gotten that big and the leverage in the system is that high. So that's really the question, is how much they're going to print really depends on what kind of, so-called landing we have. If it's not a Goldilocks soft landing, and the Fed isn't able to land this jetliner on that piano wire, then we're in for some sort of expansion that's rapid. But the flip side, the other side of that is, if we do somehow engineer this soft landing with all this fiscal spending, another thing we could talk about, you will just continue to have expansion of the M2. We're seeing it now. That's just started to expand again. And so that means that we're injecting liquidity back into the markets. It's not contractionary. We're actually injecting liquidity back into the markets, which is inflationary.
Now, with all that, then yeah. So let's talk about that. Let's dive into the possibility of like a soft landing. How would they even engineer that at this point? Because it seems like just with the printing, that's just essentially kicking the can down the road, and then something else is going to eventually come up. It's like, I feel like it's like the meme of the polar bears pushing the beach ball underneath the water. It's just a matter of time before that thing shoots up. So like, I mean, with all these cracks starting to surface, it seems like something's got to break, and it seems like the Fed's interest rates policy, they hiked rates way too fast, and because they're human, they're probably going to hike rates or cut rates too late, and at that point, then things are just going to start to break. And traditionally, when you see interest rates being cut and like kind of reverting from that way, that's generally when we see a recession. So it seems like a recession's a matter of time. It's just really the severity. Am I kind of getting right on that?
Yeah, no, you're exactly right. And typically the Fed they're reactionary. They react to lagging data too late, and they react to lagging data and to raise rates, and they react to lagging data too late to lower rates. However, there's a few things going on this year that are a little bit different, a little bit unique, and in this situation. And one of them is just the sheer amount of money that they pumped into the markets. They're just the massive amount of liquidity that's out there has been. So what we see, Brandon, is we have been in a period for the last, call it 18 months, of fiscal dominance. And that means that the US government is spending way more money than basically what the Fed is. So they're expanding the money supply at a faster rate than the Fed can contract it with QT and with raising rates. So what that's created is, we're seeing pockets of recession, and you could see it in interest rate sensitive industries. Obviously we see it in the commercial real estate, especially in the office real estate, that's gotten hit hard with the change in dynamic on how people actually work, and they go to work or sit in an office. A lot of a lot of companies don't need that office space. You're seeing buildings that had sold for hundreds of millions of dollars get picked up for $3, $5, $10 million, and in these major metroplexes. And so that's been a problem, and that it's going to continue to be a problem. But and then some companies that rely on high or floating rate interest on their debt, those companies have been struggling, and you're seeing layoffs in certain companies, especially in tech companies that are having to borrow, and they can't keep up. And then on the flip side, you've got this tremendous growth, and just it's actually been quite resilient on the sector and on the services sector side. Well, why is that? Well, remember, you've got these houses. The housing market has exploded in value, right? So you've got all these. The majority of homeowners are boomers, and they're sitting on these assets that have appreciated tremendously. They've got expanded benefits from the cost of living adjustment on their Social Security and Medicaid, Medicare. And then they've got their stock portfolios that have appreciated. So at the same time, you've got these boomers that they've just basically retired early, and they're just out there spending money. You can go out and you can see a lot of restaurants, older, especially out here, older couples and older people they're flying around the world. They're going to restaurants, they're going to hotels and resorts, and they're spending this money because they're able to spend it and feel good because they're sitting on a pile of assets that's basically doubled in the last number of years. And so you're seeing services sector do very well. And again, a lot of that has to do with um, it also is in certain areas of like infrastructure spending and green infrastructure from the so-called Inflation Reduction Act that's been very inflationary, the way that the government is spending. And so you're seeing pockets of expansion in the economy while you've got pockets of recession. So they're kind of battling each other. So how do we engineer this soft landing? Well, keep spending, keep spending, keep spending, play chicken with the Fed, and the Fed's playing chicken with interest rates and making sure that the unemployment doesn't rise too fast, and then they cut rates. And so what we're going to see is we're going to see our first rate cut next month. They're going to cut by 25 basis points, maybe 50, probably 25. And then it backs off some of that interest. Is it really impactful? No, but mentally it shows that era of high interest rates is over, and they're going to start bringing them down. And so over the course of the rest of the year, I expect interest rates to come down by a full percent. And so that means that your interest rates are not 5.5%; they're 4.5%. It could kind of jostle open the housing market. It could make some that turnover occur, and so we start seeing a little bit different environment. And then there's a lot of uncertainty with the election. So both parties will be inflationary, I believe. I don't believe that either party is going to stop spending. I believe that they're both going to be inflationary. It's just a question of, is that spending going to be more useful or not? Is it going to be in energy, or is it going to be in traditional energy and energy that would spur up productivity, or is it going to be programs that are kind of wasteful that we've seen recently in this administration? So it's hard to say what the outcome is going to be. But again, there's no other path but to inflation. It's just a question of how quick it is, how much it is, how just how rapid that inflation rises.
Yeah, and it's kind of interesting that you're lining this out because, I mean, you think back to 2008, right? I mean, like housing prices essentially crashed, but in big inflationary times, you generally see hard assets, kind of rise up pretty well, right? As you're describing here, right? I mean, we've seen the past like 5 years. So in the short term, do you think that's going to be a negative for our hard assets? And then in the long term, once they start printing, that's just going to make things take off? Or, what does that mean for things like Bitcoin, real estate, all that? Are you looking for the best way to store your seed phrase? Well, I've got it for you. It's StampSeed. They've got the #1 punch place where you can order a full-on package where they've got every single thing. They've got all the letters. You could just get it in there. And they've got this sick hammer, which they've engineered to make it so easy for you to punch in that titanium steel plate and store your seed phrase in the most secure way possible. So go ahead and get your Bitcoin off of these exchanges and use promo code Green Candle for 15% off. They're helping power the show. They've got the Bitcoin logo. You can punch it into your seed phrase as well. If you could see it here, they've got a lot of cool stuff. And now I'm helping empower you to get your Bitcoin off an exchange utilizing StampSeed and storing your seed phrase in the most secure way possible. Now get to it. All right, back to the show.
Well, you see it today. Gold is a pretty good indicator, and gold's touching all-time highs. And so why is gold doing that? Well, there's a few things. First, it's uncertainty. Like geopolitical uncertainty is growing. You see what's the unrest that's out in Europe. They don't talk about it that much, but there is serious unrest with the citizens in the UK and some European countries, and France and Spain. You're seeing it. So you've got that going on at the same time that and Germany is struggling with energy. Like there's some geopolitical unrest. That's just on the underlying structure. But then you've got these huge proxy wars that are bubbling around between Israel and Iran. You've got Russia and Ukraine, and these are there's enough geopolitical tension there that either one of them could blow up into a full-out war for us. And so we're concerned about that. And so you could see gold is catching some interest here, partly because of that. But I think partly it's also just to get ahead of this inflationary environment, because the reality is that if we do have a market sell-off, the Fed doesn't really care about the stock market in and of itself. It only cares about the stock market in terms of, would a stock market crash, would that precipitate a recession? Would it impact the bond market negatively, the treasury market in particular? Would it impact the debt markets? Because if it would, then they care. So it all comes down to the debt. And so what you're also seeing there in gold then is the reality of, yeah, we may have some short-term pain where we have a market shock where everything correlates to one. Everything correlates to one. It all sells off. Why do we say that? What am I talking about there? Well, if you're an investment manager and there's some sort of unrest, especially on a weekend, Israel gets bombed or something happens where there's a flare up and it's serious. And it's already serious, but you know what I mean? It explodes into something that's much greater than it is today. If that happens, then what happens is an investment manager, or you have something like the carry trade that we saw the other day, something like that, where you have a leverage system that kind of collapses on itself, which creates some sort of contagion, which would then reach other large companies or industries or whatever it may be. That means that you have such great uncertainty that you end up in a situation where investment managers walk into their office and they say, just sell 10 or 20% of everything we own. I just need to get cash because I know I'm going to get margin calls on something. I just don't know exactly where. So just sell 10 or 20%, raise cash, get me out of the way. Let's let the market settle down and we'll figure out where we are afterwards. Well, that means it doesn't matter. They're selling everything. They're not just selling NVIDIA and Tesla. They're also selling, Bitcoin. They could sell it over the weekend. That's the first thing they sell. They're selling gold. They're selling stocks, bonds, treasuries, whatever. It doesn't matter. Just get me out. I need more cash. And so everything drops. And that's why we call it correlation to one. So if that happens, that's when the Fed and Treasury swoop in really quickly and say, whoa. We can't have dysfunction in the Treasury markets. So we're going to inject liquidity. We're going to step in and we're going to be there. We're the safety net. And that's called the Fed put, where we're the safety net. We're going to step in. We're going to instill confidence in the markets by injecting liquidity in there and being the backstop. Don't worry, we've got this. And so you would see that V sell off and then that recovery quickly on the other side, because they would come in and stabilize the markets as fast as they can. So that's what you're seeing in gold is you're seeing that anticipation of that regardless. So even if gold sells back down to 2,200, 2,300, gold investors don't care. They're like, it doesn't matter. Long term, this thing is going to double or more.
So yeah, I mean, it seems like it's, the gold is always kind of the signal, right? I mean, Peter Schiff obviously famously, screams that from the mountaintops. But with Bitcoin being liquid, you mentioned that would be the first thing that people sell off. Now, obviously this crazy psychopath hodlers out there are like, foaming at the mouth hearing that. But, why, why do you think that Bitcoin would succeed in an environment like this? Is it simply just because it's a hard asset? Or do you think, once the sell-off happens, it's also the liquidity of the market being 24/7, 365 can be an initial disadvantage where people could sell it off on a Saturday night at 11:30 p.m., but they could also buy it back up at 11:31. So is it a positive and a negative? Like, how do you view that? Are you looking for a way to live on a Bitcoin standard? Have you been trying to do it? You just can't figure it out? Well, I've got it for you. It's at BitRefill. You could go to bitrefill.com/invite/green candle to sign up, where you can use Bitcoin to buy gift cards on Airbnb, Uber. You could buy plane tickets with Bitcoin, so you can travel the world, see everything going on. You can even buy eSIMs when you're there to help contact your friends and family. So go ahead and join the revolution, live on a Bitcoin standard, so you don't have to wait for the banks after you sell your Bitcoin, transfer the fiat to your bank, and then go through all the rigmarole, all the fiat trash that you've tried to get through and avoid. Avoid all that. Use BitRefill and sign up here today, and I'll give you $5 towards everything that you are buying with BitRefill. All right, enough from me. Join the revolution on the Bitcoin standard, and back to the show.
Well, there's a few things. First of all, you've heard the expression Bitcoin volatility is a feature, not a bug. And I do believe that I posted something about it last night. Michael Saylor was talking about it. But okay. In reality, Bitcoin's volatility is due to two major things. Number one, it's a nascent asset. It's tiny. It's a $1 trillion asset in a $900 trillion investable asset world. It's a tiny percentage of it. It's less than, a quarter of a percentage point of it. It's tiny. So that's number one. So big money moves around. They can move this thing really quickly. It just doesn't have the underlying value, the assets, the valuation that would be able to swallow those moves without volatility. That's number one. Number two, you have great uncertainty and lack of knowledge. So you have speculators that are in Bitcoin that don't really understand what they own. And so when they do get into a period of great uncertainty and market volatility, they'll sell it because they don't understand it. Whereas people like you and me might be standing there buying it all the way down because we understand it. We get what it is. And we have a much longer time horizon. So the key to Bitcoin is to have a long time horizon. The key to Bitcoin being a tremendous store of value is having a long time horizon. It's not worrying about whether or not it's up or down 5 or 10% today or tomorrow. It's worrying about where it's going to be in 4 years, 8 years, 12 years. Like that's what really matters. And so that's why I believe in it long term. But it can and will continue to be volatile. And if we have a market shock, it could very well be just like everything else and correlate to one. However, remember what happened back in the spring of 23 when you had the collapse of Silicon Valley Bank. Sure, Bitcoin started selling off just like everything else, but then it ripped higher. I think it was up 50% in just a few weeks because people realized, oh my God, there's something wrong with our money. And if the Fed doesn't step in and save it, and save these banks, then we could have run on banks across the nation. And I don't want my money sitting in a bank that I can't get to. You've seen people walk in and say, I want my money. And they say, no, you can't have it. Or you see them asking to transfer the money to an exchange or someplace else. And they say, no, we're not going to transfer it there. We're not going to transfer your money to Coinbase or wherever. You've seen this happen. And so people got nervous and Bitcoin became an escape boat. Became a lifeboat for people. But it was short-lived. The Fed and the Treasury stepped in with another acronym, this time the BTFP, and they saved the banks, their bank term funding program. And so that flight to non-fiat based safety was short-lived. Whether that happens again, my thought is it will. Is it this time? I don't know. Does it happen in the future? Absolutely. And can the US dollar hyperinflate? Of course it can. And it will if we continue on this path. There's just no other way about it.
Yeah. So then, I always see like kind of, I guess, two paths to get to a hyper Bitcoinized world where, we kind of go down the hyper inflationary route. Everything crashes and burns. And then in order to get back to, I guess, a greener pastures, we have to rebuild society. And it's kind of a slow, painful way. Now, it seems like that's the way you're kind of seeing things. But the opposite side of it, I see kind of a slower transition where, maybe we get to this inflationary time where it's, the 2% inflation and just kind of keeps going, going, going. But we're building Bitcoin businesses, we're building Bitcoin kind of circular economies on the side. And then it becomes a slow transition where it's not quite as bloody. Now, which way do you see? And do you see us like getting to a hyper Bitcoinized world, I guess like sooner rather than later because of the Parker Lewis theory here, gradually then suddenly?
Well, I think it is gradually then suddenly, but my gradually is a long, long time. Remember, we're in a bubble here. We talk about Bitcoin every single day. Most people, that I talk to, it's like, oh, do you own any Bitcoin? Yeah, I own that Ethereum Bitcoin. They just don't understand. They have no idea. They don't understand the differences of them. They don't understand the underlying properties of them. They just think that they're still, speculative coins that are basically in an online casino. So their trust is in the U.S. dollar. It's been their trust. They've known the dollar since they were very little, and they've trusted it because you can go anywhere, basically anywhere around the world, and the U.S. dollar is taken. People will take your dollar. So it's going to take a very, very long time for that to change. And I don't expect it to change for a very long time. I expect the dollar to actually swallow a whole lot more currencies along the way. That, when you have a hyperinflationary event, like you do like you've seen in Zimbabwe or Venezuela or Argentina, that they'll turn to use the US dollar because that's the one currency that's stable enough and trustworthy enough. And but so I think this can last for a very long time. This is not something that's going to be over in the next 3 to 5 years, in my opinion. I think this could last for decades. Does it collapse into a hyperinflationary situation? And that's possible. It's if nothing changes, the way that we're seeing the debt being piled on, the deficits continue to grow. Our unfunded liabilities growing. There's no question that we can hyperinflate, and we will eventually. And when does that happen? Well, it happens when enough people lose confidence in the US dollar as something they actually want to hold on to. They want to accept because, man, inflation is so bad that I can't trust that the dollar is going to be worth tomorrow what it was today. That's where you get into that situation. People they just don't trust it. So, and when that happens, that's the hyperinflationary event. Does Bitcoin become the global reserve currency, global reserve asset? I mean, I would say that it would be more along the lines of store of value than the currency, because it's a place where, just like gold, but gold upgraded by a factor of 10, you've got this tremendous store of value that you can then issue and attach debt to. You can pin to currencies and trade around. And so that to me, like you're talking about in your first scenario, would be ideal, is where you have this operating system that you're testing and growing along the way, and it's ready for prime time. It's ready to really take on that world reserve label or status, where it can stomach all of that movement and all of that the trillions and trillions of dollars that move in and out of it every day.
Yeah, and I think that Bitcoin's still, a long ways away before it could get there. I mean, I know that there's a lot of development, a lot of people working very hard behind the scenes, or even, I guess, quote unquote, behind the scenes, right? I mean, we had 30,000 people at Nashville, but there's still, like you said, I think the general public is still not quite awake to what everything is going on. But, we did just have Trump and RFK Jr. And, now like Bitcoin is not necessarily in the policies aspect of it, except Trump did mention that he doesn't want to sell any of, the Bitcoin that they seize. Now, do you hold any weight in that? Is that a way that can help, kind of pay down the debt? In a sense, or do you think, I mean, the spiral is just out of control, that maybe now Bitcoin could keep up with it at this point?
Yeah, I mean, that's got to be signed into legislation. That's a long process. I don't see that just happening right away, for sure. As exciting as it could be, look, there's a lot of political rhetoric out there. I've experienced the negative side of it. I've experienced the, choke point 2.0 and Elizabeth Warren and all of that, the anti-crypto army. And unfortunately, because with my hedge fund, I've experienced that and seen it with my companies. So it's welcome. It pleases me to hear Trump and Vivek and RFK Jr. talking about it. That is a positive. Senator Lummis has been tremendous. She's been awesome champion for Bitcoin, senator out of Wyoming. However, there's still a lot of political rhetoric, and I guess the most positive thing out of it is that it shows that they aren't opposed to Bitcoin like the current administration is. So that's the positive. What happens out of that, I don't know. Does Bitcoin need them to be positive and enact positive legislation around it? No, it doesn't. Would it accelerate adoption? Maybe it would legitimize it even more. So especially if the U.S. government was announcing they're going to hold it on their balance sheet for ever, that would be a positive. But we'll see what happens.
All right, so I mentioned it a little bit at the beginning, but I'm gonna give you some hockey terms because you're a former hockey guy. So I'm gonna play a little word association. I have a list of people for the Bitcoin space that I want to see what you're chirping at them, whether they're a beauty, whether they're a pigeon. I've even got grocery stick on here. I have no idea what that means, but somebody told me about that. Dust or a bender. So. Whatever hockey chirp comes to mind, I want to hear what you say just kind of off the bat. You can explain it a bit if you'd like, or we could just kind of go through them. But
these may be new chirps that have evolved over the time that I wouldn't know. So let's hear it.
All right. Well, if you've got some old ones, then feel free to toss them in there too. But the first one off the bat, the list, Michael Saylor. How would you describe him in a hockey terminology?
Michael Saylor. That's a good question. So he would be in hockey terms. I mean, look, he would be like a Mark Messier, where he's got this team that he joins, and he's got this experience and this deep knowledge of his sport, and he's just this relentless, intelligent, very disciplined leader. And so I would say that he's the kind of guy who can rally the team around him and take charge and really put his money where his mouth is. And so if you remember back in 1994, and this is the team I played on, tried out for, didn't play on the team, played in exhibition with them, but the New York Rangers back in 1994, Mark Messier came into that locker room. He said, we're going to win it this year. And he did. He went out there all the way through the entire season, led the whole team. And you remember, he played with Gretzky. He's like, he knows what's up. And so, and then the end of the playoffs, he vowed that he would ensure that they won that necessary game. And I believe it was Game 7 against the Canucks. And he wound up getting a hat trick to ensure their victory. And that's the kind of that's what I see him as. Is this the guy who's just going to be in there in the trenches with you and grinding? And he's out there on podcasts, he's out there on news channels, he's talking on Twitter, he's interacting with people, and he's working at it. This is a guy who's a billionaire. He doesn't need to do all this stuff, but he's doing it, and he's doing it cheerfully. So it's pretty cool.
There we go. I love it. All right, next one, Peter Schiff.
Peter Schiff. God, he's the guy that I would say he's like the guy, he's that chippy. I don't know. I don't think I want to define any player that he would be, but I think he's the kind of guy that you'd love to have him on your team, but he's just never on your team. He's the guy on the opposite team. He's just so annoying because he's so good at what he's saying, and you agree with him on so much, the way he plays. He agrees on all this stuff. He agrees the government's out of control. He agrees the deficits are out of control. He agrees that we need some standard and some hard money and some, but then at the end, he's against you because he believes in gold, not Bitcoin. So I would say he's that annoying player on the other team. He's that nudge, that needling player that he's always out there needling you behind your knees. He's like kind of just like going by, the ref isn't looking. He's going to give you that little poke behind the knees, and you're like, what an a-hole, So that's kind of what that's kind of Peter Schiff. You'd love to have him on your team, but he just never seems to be on your team. He's always against you.
Yeah, 100%. He's like a bruiser, right? I mean, whenever you need a
Yeah,
guy to go
not
in
even.
the
He's just more like a needler. He's just like
yeah.
eh.
There we go. All right, last one, Lynn Alden. This one should be a little bit easier, that less political, and there we go.
Lynn Alden.
Yeah.
Oh man, she's the one. I would say she's the one who, like in Moneyball, where she's explaining why everything's happening and how you need to adjust your strategy in order to be in the right position to win the championship, who you need to draft, how you need to do it, where you need to spend your money, where you need to save your money, why the math works, why the trajectory works, and how the statistics come into play. And if you do that, you're going to be okay.
There we go. I love it. Well, James, thanks so much. You've been very generous with your time. Why don't you tell people what you got going on and where they can find out more about you?
Yeah, so I am, you know that I'm the co-managing partner of the Bitcoin Opportunity Fund. I manage that with David Foley, and it's closed right now, but we invest in the Bitcoin ecosystem. It's all Bitcoin opportunities. But we might have another fund, and we'll likely have another fund in the near future. So if anybody who's accredited, you have interest, you can reach me in james@bitcoinopportunity.fund. But then every Saturday I write The Informationist, the newsletter that breaks down one financial topic that's usually pretty complicated, that people hear all these terms and acronyms, but I break it down super simply for people. And that's been great. It's got like 37,000 subscribers on it now. And I love doing that. It comes out every Sunday, and that's on Substack. You can find it at jameslavish.com. Pretty simple.
All right. I'll put all those in the show notes. And James, thanks so much, man.
Yeah, buddy. I appreciate you having me on, and look forward to the next time.
Thank you for tuning in to the latest episode of the State of Bitcoin podcast. If you really enjoyed this one, I've got another one cooking up for you. You can click that right here, and you can go to the next episode, which is an absolute banger, where I'm bringing you only the latest and greatest guests. Or if you're looking for more macro-related content, you could check out my other channel, Macro Insights Pod. I got it linked for you right here. So where I'm bringing you more about stocks, real estate, traditional finance stuff. So go ahead and check that out. And if you enjoyed this podcast, go ahead and hit that like, hit that subscribe button, and tell a friend to tell a friend. All right, enough from me. I'll see you at the next one.